Why should passive investors trust your process right now?
I don't know if there's anything really, really passive. If someone were to mess, like there's two things in life you can't mess with, money and health. We happen to have 50% ownership of our AUM. So only 50% is external capital. If you were to invest with Bequest, you are in a preferred return position. What the heck does that mean? That means you get paid first. So you get paid before the GPs do.
Investors and operators, welcome back to the Invest Clearly podcast. I'm the CEO of Invest Clearly, Pat Zingarella. In this GP episode, Chief Strategy Officer of Invest Clearly, Joe Guidi, sits down with James Keefe, Chief Commercial Officer at Bequest Asset Management. James shares how the firm began with 5 friends investing their own capital and how it grew to serve more than 220 investors. He also reflects on his own transition from LP to GP and how that experience shapes his approach to investor communication. They talk about Bequest's vertically integrated model, the role of founder involvement, and how they've structured offerings to include both accredited and non-accredited investors. Let's get into it. The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice.
James, good to see you.
Joe, what's up?
Yeah, really looking forward to this conversation. Been wanting to talk to you since I started doing these podcasts. And so, really love the approach you guys are taking at Bequest and looking forward to diving in.
Thanks for having me. Appreciate it.
Yeah. Can we start by just, for those who might not, know you or Bequest, just give like a quick overview of Bequest for the audience?
Yeah. Bequest Asset Management. We're here in Sarasota, Florida, the epicenter of the financial world, right? A lot of people don't think like south of Tampa, this is where people launch an asset firm, but yeah, we're one of the few in the area. But as everyone may know, the migration to Florida was fast and furious the last few years. So it's not, if you haven't been to the state in a while, it's changed a lot. But the company's been around 5 years. Martin and Sean Munyo are the 2 core GPs. They've been investors since, since they were born, it seems like, but
right.
They've been investing themselves since like 2008. Martin, well published mortgage note investor. And then Sean Munyo was doing the slumlord kind of thing. And then spent 20 some years in corporate America on the tech side. They got together around note investing. That's sort of where the business started. And they didn't even launch a fund for quite some time. They were just doing it for themselves. And the first fund launched about 5 years ago. So I think that's important. It's a company that started as investors. So they built this to sort of generate their own wealth. And then when they got good at it, it was like, hey, let's open this up. Let's build a company. Let's invite some family and friends around. And now it's grown to 220 plus investors. And now it's become its own asset management firm, if you will.
Got it. Thanks. And could you just talk to us a little bit about your role and kind of like where you enter the picture in that story?
Yeah. So it is kind of wild, man. I started, believe it or not, I was an actor, a failed actor in LA. After college, I had this dream of like, well, okay, I don't know how far down this rabbit hole you want to go, but I was
give us the 3-minute version.
Oh, well, okay. 3 minutes. Okay, real quick. So I was the mascot for the University of Wisconsin. So I was Bucky Badger. And they flew me out to California to do this commercial. And then I got caught up in this dream of wanting to be an actor, and then struggled for years, moved to LA. I was cast on this show called Hang Time. And you're young. I might be dating myself. But anyways, finished that chapter of my life, got an MBA, grew up, and then I joined pharmaceuticals for 20 years, actually. So most of my career was in pharma, but on the side, I was investing. I started off in the equity market. I started scaling my real estate portfolio, and I built up enough passive income. I actually retired out of pharma and moved down here. And I was caught by my partner. She's like, "You're sitting by the pool talking to the dog. You got to do something more." And I wanted to throw myself into the financial sector, and I didn't know how. And I came across Bequest 3 years ago. I met the guys, Martin and Sean. And I said, hey, if you need some help, I'd love to grow your firm. I'd love to educate myself as a limited partner. I wanted to learn how to invest, grow wealth beyond just the equity market and real estate. I wanted to learn about private credit, private equity, note investing, other ways to generate wealth outside of just the traditional channels. And that's my journey over the last 3 years. I'm now the chief commercial officer. I head up all the communications, the investor relations, just trying to take care of our new and our existing investors, making sure they're having a good experience.
Got it. Yeah, that's so. Just if I can punctuate this, that sounds like you had, if I heard that right, you had actually retired through passive investing completely, and then kind of came back to it. Got it. So you're.
I don't have to be here. I don't know what I'm doing, Joe. I got to find.
Why are you on this podcast right now? Doing with yourself. Yeah. So you probably, safe to say, like, you approach you're bringing that perspective as an LP to your interactions with LPs. You would think.
Yeah, I think that's what makes me feel great about what I'm doing, and that I've started to learn the industry a little bit. I've gotten a peek behind the curtain, even on the financial advisor side. So there's a lot of incentives out there and you could probably make this argument in any industry, right? I saw it in pharma actually as well, right? So It's really interesting when you get behind how people are incentivized. And, the good thing is, I feel like, even I'm going to give you a real talk on this podcast. I'm very real with people I interact with that come to us. And I don't like to go into the deal or anything until I understand what the heck's going on. Like, Joe, if you were interested, we would talk about just, what are you trying to achieve? What are your goals? And if even if the fund offerings we have don't make sense, I got plenty of network I can refer you to other people. I'm just trying to get through this world together, help people grow wealth so they can become more free. So we're not, sort of attached to a job because we have to earn a living. But I really, at this point in my life, get a lot of reward from helping people achieve their goals. It's a really cool thing. So that's why I like sort of being in that position. I don't feel like, I have to do this. I actually want to do it. And along the lines, I get an enormous amount of education and empowerment from it.
That's cool. That's really cool. So why don't we dive a little bit more into Bequest and the process? I guess, if obviously trust is a mechanism, important mechanism or element of the passive investing journey, right? It's one that is, there's some tumult around it right now, based on some firms having bad press and so on and so forth. And we've seen it. Investor confidence is shaken. The decision cycles move a little bit slower. Why should passive investors trust your process right now?
Yeah. Well, I kind of feel the whole passive thing isn't interesting. We could probably go down that road. I don't know if there's anything really passive. I think, you sort of get your active income, you're working, you got your W-2, you're trying to live below your means and use that money to invest in things that hopefully take the pressure off of having to work. But if anyone bought real estate, I had a massive portfolio. That whole thing is an animal. So then you're like, okay, is there another way? Well, there's all these syndications and operators and things like that. That whole game is different. If you're not buying, if you buy a property yourself and you control it and that asset turns out one way or the other, it's on you. But how do I sort of evaluate these thousands and thousands and thousands of operators that are out there? And it's easier to find a rating on a hotels.com or whatever to figure out what hotel to stay in. But if you're trying to figure out basic stuff around, are your LPs satisfied with the returns you're marketing, it's really hard to find that information. I think that's what's being built out here, which is phenomenal what Pat's doing.
We are trying to solve that problem. Yes, definitely.
Yeah. And, it's kind of like the hard questions that I feel like need to be asked. That's probably the biggest thing I've learned is I've seen behind the scenes of how hard an asset firm has to work to deliver the returns. It's more or less marketing. It's not easy work. So, our process is very rigorous on the inside. Now, an investor doesn't see that. They pretty much get their monthly distribution or they get their sort of monthly report that shows we're hitting our marketed returns. But I know how hard that is. And, there's several things of our process and it's also people. The founders of the company are still very much 100% engaged. So that's one of my big questions is like, where are the founders? Are they still working the grind? Are they going after it? Second question is how much skin in the game? We happen to have 50% ownership of our AUM. So only 50% is external capital. So sizable skin in the game. We invest way early on an asset strategy before we invite external capital in, because I also know the heartache of like, if someone were to miss, like there's two things in life you can't mess with. It's money and health. And I knew that from pharma. You can't push out a medication and then all of a sudden it goes sideways. So from a asset performance, you absolutely have to have some skin in the game. But I would say, the philosophy is understanding what a firm's investment philosophy is. We happen to be cash flow investors. So we look for assets that are cash flowing. We will analyze an asset cash flow performance before we go and acquire it. And then we're going to control it. So we vertically control that asset. So we're not going to leave that off to a secondary operator that may or may not be able to perform the way we want it to perform. And then the third one is we'll pretty much make sure that it's serving our values. So we want to invest in things that service the community. So when we invest in mortgage notes, they're performing. We want that homeowner to stay in their home. We don't look to foreclose or anything like that. On the energy park side, we make sure that these are renewable sources that are doing good by the community. And the last thing is we try to keep it simple. We try to keep it around assets that people need. Real estate, energy is where we're comfortable. I think it's great if an asset firm goes outside of its historical track performance and tries to diversify. But as an LP, you just got to be careful about that. Like, okay, tell me about the talent. What are you bringing in to make sure that you understand that asset class? If I'm deploying capital into a new area that you're shifting your strategy in. So these are just hard questions that I've learned, Joe, as now an LP when I invest, is I'm not afraid to ask, where are your founders? What's their background? What's your investment strategy? Show me your track record. Show me where capital is being deployed. How do I know I'm getting into a good deal?
It's really interesting. Like obviously we collect reviews from LPs, and we've seen reviews come in recently where LPs are being very direct around those issues. Either founder involvement. Do they feel like they're taking accountability? The other thing that's happened, a lot of low reviews in kind of the fundraiser environment, firms that appear to be capital firms, but they're really raising for other folks. And I think that gets the skin in the game issue, right? So basically what I hear you saying is, you said it very clearly, but I'll restate it. Like when an LP is evaluating an investment, they should be looking for how involved is the founder, both their time and money.
Yeah. And are they just doing like a deal? Like, I don't know. The other thing I thought was interesting, I think, if you're an early limited partner and I remember like years ago, I was at a Bigger Pockets conference, and this is right when I started to entertain the idea of maybe doing like a syndication. And it's interesting, like you start coming across and they're like deals, like do this syndication, do this one. It took me a while to mature a bit and understand private equity firms, private asset firms. And I'm not talking like BlackRock, KKR, because those are like, you could go to a financial advisor and they'll recommend some sort of set of that deal on something. But if you're really trying to go like emerging manager, boutique manager, get maybe a richer deal directly with a founder, this is where I think are founders scaling a company? Are you building like a company that I'm also investing in, not just a deal? But so that's where like the deal pitching or the hired hand and things like that, it starts to fall like into a value thing too. And that's where the second half of who do you want to go ride with? Because do you want to invest in 20 different deals with 20 different operators? Or are you trying to look for a handful of operators that are scaling a business that are going to be like that next generation that you can sort of go into the private market and grow your wealth outside of the public markets and whatnot?
Yeah, that makes a lot of sense.
This episode of the Invest Clearly podcast is brought to you by Scale IR. If you're raising capital, you know the hardest part isn't just generating leads. It's turning those leads into committed investors. That's where Scale IR comes in. Scale IR transforms your investor engagement process with their proven solutions that optimize lead qualification, accelerate investor conversations, and drive higher conversions. From seamless CRM integration and intelligent workflows to expert investor qualification specialists who handle your initial discovery calls, Scale IR gives your team freedom to focus on closing deals. If you're ready to scale your investor relations and capital raising effectiveness, Visit scaleir.com to learn more and book your strategy call today. Scale IR. Engage smarter, convert faster.
Let's talk about communicating that though. As obviously chief commercial officer, you're in charge of investor communications, investor relations. Yep. How are you communicating that to your existing LPs as well as new folks? I mean, you guys are already at a variance, you're doing lots of things. Naturally, you're encountering new people, it's a competitive environment. How are you communicating early to build trust with LPs?
Yeah. So I get all over myself as well. But if my team starts deal pitching early, I get real frustrated with that. Cause this is where, as an LP, when I go to conferences, you just feel it. You're like, oh my gosh, we're going to go to Limitless. And I know it's going to be a pitch fest. Everything's up and to the right, which is not true. And you get overwhelmed by all this information. What I think is unique is when you run into somebody and you have a conversation around, hey, Joe, what are you trying to do? Are you trying to grow? Are you trying to get more passive? Like, how are you, what are your interests? What is your asset? Like, you might be interested in like storage facilities, and we don't do anything like that, but I know three really good operators. I don't get incentivized by referring you over to them or whatnot, but I'm just trying to help you get to your goal now that I understand what your goals are and what your interests are. So to me, I think it's education, value, give it away. Like we hand out all of our free stuff. There's not this, like, I'm sure everyone's seen these, like, hey, here's a $500 packet. And if you go in today, it's $99. And then behind the scenes, they're not going to push a deal. Or you all of a sudden like download a white paper, and next thing you know, you get like 8 calls hitting your cell phone and pitching the deal, right? We just give stuff away. And what we've seen over time, and I know it's longer and there's pressure and people trying to raise capital, but we find that the investors that really stick with us are the ones that we've done these webinars, we've done these conferences, we put out content, we educate people around due diligence, around assets, around investment thesis, fancy things like that. And it's sort of a relationship built. And from there, if a deal comes up and it makes sense, fantastic. If not, no worries. We're both stronger and empowered by sharing education amongst each other. So that's for me, that's a principle that we lead with, is just adding value, giving it away, and trust that, that when a deal comes up, there's a chance that maybe someone, or may or may not, depending on where they are and what their goals are, may invest in. And we're totally okay with going with that philosophy.
Yeah, I think creating alignment is really, really important. That's, between like what the investor is trying to accomplish and what they care about, and your offer early, because to me, as a lifelong seller, right, most of my career has been in sales. Like, there's nothing that I think is more kind of obnoxious is probably there, or than like someone coming on and talking about the thing they have to offer without any idea of whether it connects with what that person needs. You got to figure that out first. So I think that's great. Yeah. So in that, I guess I don't want to like lead the witness here too much, but could you share a time where you feel like either, I guess, in your own investing, personal investing as an LP, or kind of as, in the leadership team of an asset management firm, LP trust was lost?
Yeah. Well, I as an investor, I got caught up in the Pier Street stuff. They went under bankruptcy. So this was when everybody, like, you could just put money in whatever. It seemed like you could make money. And right. Joe, this is when I was saying like, this is before I got into the private asset world. I was just a limited partner, sort of working in pharma. I'd scaled my real estate. I was like, well, what else? And this is when the fintech companies were coming out and these bridge loans, right? And the rates were low, and I was making like 10, 11%. And then all of a sudden, boom, it dried up. And then boom, 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 you could see the deal flow get wiped out. I pulled most of my money out. I still have a little bit caught up. They've been in bankruptcy for 2 years. And I did pay attention to my position on the investment. So my position on the cap stack was like really low, probably at the level of like a common stock. And that's why I'm stuck with a little bit of money still in there, just waiting, and maybe I'll get it all back. Who knows? Bequest, we haven't, we've never missed a payment and all that kind of stuff. But I think where we ran into some challenges is we have had explosive growth. Like we literally went from like 100 investors to like 230. And this is what I was saying, Joe, about like
Over what period?
like 9 months.
Oh, right. This is just
when we launched our Reg A, right? Not a lot of firms do Reg A. We do regular, technical term, but like non-accredited and accredited. So we have both now, and that adds like regulatory compliance. And we wanted to go there. We're sort of the theme of trust. Like we're now a licensed registered investment advisor firm in the state of Florida. Doesn't mean I'm an advisor, but we got that shingle because what we are now held to a fiduciary responsibility of our investment.
Higher level of scrutiny, right?
Yes, but we're scaling, right? So if you're going to scale, you got to bring everything. You just can't just raise capital. You got to bring a whole structure with you. And so what was missing for us is sort of a concierge team. We sort of underestimated what investors, in particular non-accredited investors, may need that are coming into our funds. And so quickly had to put together a concierge team, white glove service. And so what dawned on me was, yes, it's great. We promote these great yields and we got these great products, but you've got to bring the investor experience along with you. And now when folks survey us or rate us, now it's like the concierge team gets mentioned in equal footing to our products. So I think, that was something we learned along the way for sure.
Yeah, I think that is something that is emerging as an idea amongst GPs, or so they're starting to come around to the idea that the LPs are not just kind of like, yes, you build great products, you work really hard to deliver returns. That is not actually enough. There needs to be more than that. Like this is a relationship.
Yeah.
There's hand holding beyond the check kind of thing. And I think it's really kind of astute for you guys to recognize. It's great that you did. I think, I've been talking if I put on my other hat, I've been talking a lot to GPs about, you got to plan past the funding, like what does the communication strategy look like post funding?
Oh, I know, right? It's about incentives. If all you're trying to do is get to an AUM or a cap raise goal, then you look around and all these GPs have a bunch of sales folks. But if you've got an incentive, which we have a rating of satisfaction, then it gets a little scary. You're like, oh, wow. Like, what are they going to say based on their year or so experience beyond the yield? Maybe they were happy with that, but did we communicate to them in a very open and transparent way? Did we deliver our quarterly investor calls in a way that makes sense? And to me, like, I think the most critical part is usually that first like 90 to 120 day window. You deploy your capital, you wire your funds, you're sort of sitting there, you assume it's landed. If a GP doesn't have communication coming back to you as to the steps of what that deployment period looks like, when that return, and then once you get into a regular cadence, it feels good. But that whole second half, I think is something that I know people that do it really, really well. Investors really appreciate that ongoing communication, and especially when you're sort of now having to keep an eye on the operator. That's the passive investing side. So maybe you're not scaling your own properties, your own facilities, your own mobile parks. You're sort of going in on syndications or with a private asset firm. Now your job's still not done. You still got to keep an eye on your operator, how well the firm's performing, how it's growing.
Yeah, definitely. And I think it's interesting. You mentioned you've scaled really quickly, and that's when you realized that you have this communication gap. We actually should be publishing shortly. We did what we call Invest Clearly Insights, should be like launching shortly. We're doing research, qualitative and quantitative research based on our reviews. And one of the pieces that we came out with is called the communication gap. And it's basically highlights that the larger firms are getting really good ratings on pre-investment communication and really bad, because we collect a few different ratings behind the scenes, really bad ratings on post-investment communication. So it's something that actually gets exacerbated as firms get bigger.
Yeah. But that's going to be great. I don't know if you guys are going to offer that to GPs, but GPs need to hear that. And
it'll be for out there for everybody. Yeah.
Yeah. I think that's awesome. It's probably maybe the way they're structured too, or, again, incentives, everyone probably has some sort of scorecard. So what numbers are you looking at? And again, I think this sort of AUM capital raise is like the main thing everyone talks about. But, and this is where I think, at least for me, being an LP, GP insider, if you will, I feel like I'm always the voice of customer in this case. And that goes back to my career, just being like you were saying, Joe, like as a seller, always keeping the customer in mind. I don't know in the financial services world, maybe that exists everywhere. I don't know. I feel like it's hit or miss, but I'm always looking at best practices of how we can improve the trust and communication to our investors. I think that's vital.
Yeah, I couldn't agree more. All right. So I want to just hit you with a couple other questions. I know we're kind of maybe getting a little bit near the end of this, but I want to make sure we talk about that. I think I was going to ask you, what's one metric you think that all GPs should publish? You just talked about kind of like a net promoter score, like a quality score on your team, but is that is that the one you would publish, or what metric do you think GPs should be putting out there?
What metric? Everyone sort of leads with a track record and, their AUM. Like if you get to like, we're about to cross over 100 million, like, whoa, now you've checked all these boxes. And I'm like, I feel like I haven't changed at all. So, like you're still just kind of grinding it out. Here's the thing that I think, I don't know if it's a metric, but we're talking about education gap. And I'm going back to the challenge I ran into with Peer Street. I just think just being very clear with investors as to the position they have with the structure of the deal. Like there's some sort of weird language out there too in the private asset world that confuses investors. But to me, like if you were to invest with Bequest, you are in a preferred return position. What the heck does that mean? Okay. Right. That means you get paid first. Okay. Yeah. But isn't there a bank involved? No, we don't have any leverage. It's actually equity build up and we own the rest of the AUM. So you get paid before the GPs do. Okay. But does that mean there's more or less or whatnot? It just depends on how we perform. Our LPs get paid first. We are going to pay you to that marketed return first. We are going to ride or die to make sure we deliver on that. And as an emerging manager, you can't afford to miss. That's why you sort of move down into the emerging boutique. Once you go into large, it's like the deals water down a bit. People miss things. Like we'll get you on the next round. When you're an emerging, fast growing emerging, you can't afford to miss. If you get a review on any platform that's less than 5, you're going to have to deal with that. You've got to ride or die with that. So a lot of our investors, at least I think, appreciate that we're very clear on the position that they have when they come into the deal, what that means and where the risk is. Because there are deals out there. If you don't ask the right question, the GP might be getting paid first. I don't know. Or maybe there's some sort of risk shift going on and you're not even really aware of that because it's in the fine print on page 75 of the PPM or whatnot. So I don't know. There's a lot of marketing things that I see that aren't as clear. And I know that's not a metric, but I would just like to see better improvement on behalf of the GPs to just clarify to the LP what the structure is. And as an LP, don't be afraid to be, I don't understand what you're saying. Break this down in very simple terms. If I were to invest with you at this marketed return, what position do I have and why?
Right. Yeah. I think that's really good. We've seen some kind of LP influencers on LinkedIn start to write about this, like, hey, by the way, the asset doesn't need to go to zero for you to lose your capital, especially depending on where you are on the cap stack. Right. So, just highlighting the fact that like the structure of these deals, depending on fees or where they are in the position, like, there's still room for the GP and others to make lots of money when their investment goes to zero. If they don't know what questions to ask, and the GP is not clear about how that's structured.
Right. And so as an LP, you know what a great deal looks like and what's not. This is where the last 3 years working for Bequest, it's really opened me up. I think we have pretty good deals, but I'm exposed to all these kind of things. I know how deal structures are put together. I know where the risk shift may happen. out to the LP community, I would say I know this is finance. If you don't come from a finance background, it can be painful. I didn't have a financial background. It has been, but I've learned so much where when I see a deal and I understand what the position I have, now I have a better understanding of whether this is a good deal or not. And I don't get caught up into the fancy yield number, because that's what people get drawn to. And they assume that that's just going to magically happen. No.
Right.
Assume that, what happens when that thing don't get delivered? Where are you positioned so that if that's going to be a good deal for you?
Yeah, that makes sense. All right. Last question. This is one Pat loves. So what's one myth about passive investing that needs to die?
Yeah. I don't know. I think the term passive, I love it though. I'm a cash flow investor. It's a little bit different than, there are different levels of passivity. Like some people think that, building a real estate portfolio is passive. I've been there, done that. It is not passive. So now I'm going to go the REIT route. Well, that's volatile though. That's not consistent, predictable. So now I'm going to go the dividend route. Well, that's not quite predictable either. And a company can always change its dividends, and there's ways to figure that out through closed-end funds and blah, blah, blah. But so now I'm going, okay, so now I'm going to go syndication, or I'm going to go private asset, private operator. I'm going to just put my money in and then totally turn the brain off. That doesn't happen either. So I don't know. I think you have to be actively involved, but there are different passivity levels, on the spectrum. I think in my experience, investing in all different kinds of things, what we do is probably a bit more passive than others, the mailbox money concept. But I'll tell you, you got to pay attention to the company performance. Once you deploy your capital, you got to stay attuned to their strategies. You got to, visit them, be on their investor calls. You got to read their read their updates, and still be actively invested alongside them and treat it that way. So I think this passive, I still love it though, because I love being in a position where at the beginning of the month, I've got this income that comes in. It's not correlated to my active income. So the beautiful part of that passive investing sort of philosophy is still there. It takes the stress away from whether I like working here or not. I'm good. I can take care of my family. But I know now at this point in my career that I'm always going to need to be actively involved. And not all of it is things that I love, like reading through net asset valuations or pro formas and sort of company updates and things like that. But hey, with the AI and all that kind of thing, I got all kinds of cool tools that I can upload documents and have spit out things that make sense for me. But that's the thing. Passive investing, how much passivity is really there. Is the part that I think just there's always going to be some sort of active involvement you need to have.
That's really interesting. Okay. Well, thank you for your time today. By the way, that's a really interesting last note, because I think that the idea that the thing about passive investing in these style is passivity. It's yeah, thank you for your time. If people want to learn more about Bequest, where should they go?
Yeah, just bqfunds.com is our website. All of our contact information is on there. Just cruise around, check out who we are. We communicate our investment philosophies first, and then a little bit about our deals. And then we do these happy hours and webinars. All that stuff is posted on our website. So just go to bqfunds.com, check it out.
Awesome. Thanks, James.
Cool, man. Thanks, buddy.
Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review, because that's how other people find the show. Till next time, invest clearly.